everybody, and welcome back to another episode of Real Estate Investing Q&A with Antoine Martel. I'm your host, Antoine Martel. The way this show works is super easy. First, people go to my Instagram at Martel Antoine. They DM me their questions. I tell them I answered it in a YouTube video. And now I am answering their questions here live on camera for all of you guys to see. Because a lot of the DMs that I do get are very repetitive questions. So I felt like if I just filmed it, put it somewhere online for people to go and look it up, reference it, etc., it would help a lot more people than just helping that one person that I DM back, right? So that's what the whole goal of this show is, to help you guys to answer your questions. I'll probably be answering around 5 questions. It goes anywhere from 5 minutes to 10 minutes long, normally is how long these videos are. So let's get right into it and go through some of my DMs. All right, the first question comes from RRUlo99. He said, Raul Martinez. He says, what is your preferred funding structure for apartment buildings? What's the minimum cash-on-cash return you look for in a deal? So my preferred funding structure for apartment buildings. So apartment buildings get a little bit tricky. So if you're buying a property and the loan is less than $1 million, then it's very hard to get financing. The reason why is the only government-backed apartment building financing is by Freddie. Actually, there's Freddie Mac and Fannie Mae, but all of them have loan minimums of $1 million. So if you're buying an apartment building and the loan is over $1 million, great. You're in that. You can go and get funding from government-backed debt, agency debt, which is going to be super low interest rate, like 4.5%, 4%, which is great. But the deals that I've been buying the deals for $700 grand, $1 million, $1.5 million. And so all the loans are lower than $1 million, which means I can't use that agency debt. So I have to go and find other funding sources for those deals. So the ways that I have been finding those funding sources for those deals is what's called asset-based lenders. The reason why I need to use asset-based lenders is because I have my own business. And so I don't have a W-2, I don't have a really good 1099. If you don't pay yourself a W-2 or 1099, then you have to go to these asset-based lenders who are gonna give you a loan on this commercial rental property based solely on the cash flow that this building produces. So normally for all of my apartment buildings, I'm using this asset-based lender to finance all of these deals. And then the second part of the question was, what do I look for in the cash flow for those apartment buildings? So what's the minimum cash-on-cash return you look for? So the minimum cash-on-cash return that I look for on a yearly basis is around 10% cash-on-cash return. And then on an IRR basis, for normally like a 5-year IRR basis, is 15%. If you have no idea what IRR is, please go look it up and then keep playing the video. All right, question number 2 comes from Weary Traveler. Hey Antoine, love the account and information you provide. Had a quick question. What happens if you have a property and the renter stops paying rent, but is still occupying the property? How do you or the property management company handle this? I feel like you can go into a major loss if this goes into a legal battle. So, if you read my book, you would know the answer to this. First of all, if you want one of my books, it's go to free.martelantoine.com, free book. You pay for the shipping, I'll send you the book. One of the first things is choosing a market and choosing where to invest in cash flowing rental properties or apartment buildings, wherever you want to invest for cash flow, because that's the most important. And one of those first rules is to find a state or a county, but most likely a state that is going to make your real estate investing business a success. And one of those things is being a landlord-friendly state. So finding a landlord-friendly state, finding cities in those landlord-friendly states that are gonna allow you and your real estate business to have success and to thrive. And so when a tenant stops paying rent, you're able to evict that tenant seamlessly and painlessly, and also without breaking the bank. So normally our evictions cost anywhere from like $400 to $500. They take probably around 14 to 30 days. If a tenant doesn't pay by a certain day of the month, we can give them a 3-day notice to pay or leave. Cash for keys is where we pretty much go to tenants and be like, hey, we know you're not paying rent. Here's $500. Please just leave the property this weekend, right? We don't want to waste any other time. We don't want to go through eviction court. We don't want to take them to court. We don't want to waste anybody's time. It's going to cost me $500 to go to court in 30 days. I might as well just give you the $500 now. You can use it and you can leave on your own accord, right? So choosing a landlord-friendly state is going to be very important when you're first starting, to help protect yourself and pretty much to get your right foot in the door for when you're starting up this business. You're going to want to be in a market that's going to help make your business a success. All right, question number 3 comes from Rhonda. Rhonda asks, hello Antoine, hope all is well. Thanks for the amazing videos you post. My husband and I closed on our first investment property Tuesday and we're super excited. I had one quick question. Should we wait and save before we get our second, or go the asset-based lending route to acquire our second investment property before the end of the year? So this was a couple months ago. As you can see, I'm pretty behind, but Rhonda, to answer your question, if you can get conventional financing and use your W-2 again and again and again, first of all, normally if you can buy that first investment property with your W-2 income and get conventional Fannie Mae financing on that first rental property, getting rental property 2 through 10 is going to be a walk in the park. As long as that property, number 1, is rented out. If your bank is telling you otherwise, please shoot me an email and we can help resolve the situation, because that's how our lenders work. So I would definitely recommend finding the right lender who's going to make it possible for you to grow a scalable portfolio. Using an asset-based lender, I definitely wouldn't recommend it for single-family homes. For larger multifamily, it's almost a necessity. It's the only way to get into the deal. But if you have a situation like mine, but if you don't have a situation like mine, I definitely wouldn't recommend an asset-based lender for a single-family home, especially if you bought that first deal with Fannie Mae. Just keep using that conventional financing over and over and over and over again until you get up to 10 properties. Then you can figure out and start to think about going in other routes and using hard money or using asset-based lenders or using private money or doing all those kinds of other creative financing deals is what I like to call them. But if you already have a system and strategy that's down and that's working, even though it just worked one time, keep scaling it. Go from number 2, 3, 4, 5, 6, 7, 8, 9, 10. Fannie Mae is going to limit you to 10 loans with them, but scale that up, get all the way up to number 10, and then me and you can start talking about what's next. And what that conversation is going to look like is, first of all, how much more cash do you have available? If you have more cash and you have the ability to buy more properties, then great. We can start looking at asset-based lending, all that kind of stuff. If you don't and you're tapped out with your cash, then okay, maybe it's time to start taking all your cash flow and using that cash flow to pay off a property. Once you pay off a property, then now that property is owned all cash. Now you have 9 loans. Now you have slot to buy one more property and get another conventional loan on that property. You see where I'm going with this? So it can keep going into infinity. You can keep doing that, repeating that process over and over and over again. All right, question number 4 comes from Elite Mind 85. Can you burr a deal when you already put 20% down on it? So I do get this question a lot, and I want you guys to really understand how a burr works and why a burr works. And so if you buy a property for $100,000, you put 20% down. So you put 20 grand into a deal, right? The property doesn't need any renovations. The rents are $1,000 a month, so it meets the 1% rule. The thing cash flows nicely, probably around $200 a month, right? If you bought it, right? And let's say you're 3 months in, 4 months in, you're like, man, I need to get that $20,000 out. Well, it sucks. You're not going to be able to, especially if you bought that thing turnkey. It was already renovated. It was already rented out. There's no really value that you can add. And let's say the thing appraised for $100,000 as well, right? So there's no the only equity you have is really the cash you put in. That's a long-term investment. That property, you're not going to be able to burr that property because there's no value add. There's nothing that you can cash out on. The only things that you're able to burr out are things where you're adding value, where the value went from 100 grand to $150,000. And then now you're able to go to the bank and be like, hey bank, I bought this for 100. I put 20 grand into it. Now it's worth 150. Can I get a new loan? That's the only way that you can do a burr. So if you're buying turnkeys or buying something traditionally that's already rented out, already renovated, you're not going to be able to complete a burr strategy on that deal. 5th and final question, BMM.OTW. His name is BMM. All right, this question is not real estate related, but he was asking about any branding tips. He's getting into the music business. So I would recommend content is going to be your number one, especially with the music business. How many songs can you put out? How much content you can put out? If you put out 100 songs a day, 100 songs a week, 100 songs a month, how many of those songs and how many of your music is going to be out there? And putting out a lot of content, especially in that space. For realtors and for real estate professionals like myself, it's like how much value can you add to the other person is always what I'm looking for, and how can you do that at scale. So back in college, I used to do it one-on-one with coffee meetings, right? But then I realized, wow, this is taking a shitload of my time. 1 hour for one person. What if I spent 1 hour creating content, doing these videos, right? This takes me 10 minutes and maybe 10 minutes to edit, 20 minutes to edit, right? 30 minutes of my time, but how many people is it interacting with? 1,000 people for that 1 hour. Maybe it's not as high of an engagement level, but that's fine. At least I'm reaching more and more people, right? So getting the attention out there, using your time wisely, smartly, and not really wasting your time doing anything one-on-one. So that's what I would recommend if you're looking to break into anything and create a brand like I have on Instagram and with the turnkey business. So with that, please make sure to subscribe, like the video below. Go check out my Instagram at Martel Antoine. DM me so that I can get your question answered on the next episode. Thanks so much for tuning in. See you on the next one.